Hey guys, bonjour, welcome. Let's talk about fintechs, neobanks, and traditional banks. What's the difference between them? Because a lot of people don't know. We're confused, especially when things go wrong. So that's important to note when we talk about that one today. Hopefully, at the end of this episode, if you see something, you see someone, or see a phone, or see an app, or walk past the bank, you know the difference between them. So if you look at traditional, right, so again, you'd see, and you notice a lot. So if you see your friend show up with like a lovely looking card or a lovely looking bracelet, payments, okay, and there's a lot of that these days, right? You see that and it looks cool and shiny, you can immediately tell where that's coming. Okay, so you have to take, right? The traditional bank just focuses on traditional. We have three types. I'll try and differentiate them now. Okay, so there's a traditional bank, there's a neobank being a new form of bank, and then there's fintech. Okay, what's the difference? So let's start from the top. Financial bank, or the traditional bank, let's call it. Now, a traditional bank is regulated, okay, in the sense that they hold deposits. They take your money, hold onto it securely, okay? Because what you see, you can put it under your bed, you can put it in your mattress. A lot of people say, hey, cash is better, cash is king. That's true until you get robbed, okay? So, and especially when you hold valuables around the house, or you hold valuables in your pocket, you know, it becomes a problem, okay? Which is different from a debit card or card these days where that gets stolen, you can cancel it immediately by contacting your bank. So I think it's just worth noting that, right? You know, traditional banks are there to hold the deposit, and that's why they came across. And again, this happened like years ago from the Middle Ages. They always had traditional banks. They hold deposits. Because they hold deposit, they are licensed to hold the deposit. They're also licensed to take risks, reasonable risks with the deposit. And that's the focus here, right? That basically, if you look at a bank, they have a central facility of holding to hold that cash together, to generate that cash, and you see this as well, especially with Feds and other central banks that actually borrow to banks. The banks to continue to borrow. So the idea, or the reason there is index, while banks are there today is to hold deposits and borrow. How does that differ from new banks? So new banks are different in the sense that, you know, they're usually digital only. And that means they may hold license, or they may use the license from the bank, okay, but they are purely digital. Okay? And the idea came from, you know, in the early 2000s when people had to show up, and you still know this, right? There are a lot of community banks that still the same. So they're open 9 to 5, okay, that means if you get up at 4 or 5 or at night, you're not seeing them anywhere because they're closed. In fact, you'll be lucky to see a bank that's open until 5. Most banks are closed at 4. Okay, and those are traditional banks that used to be there. And then obviously, if you're going to open up a bank, you have to be there for them. Okay? Secondly, if you're going to withdraw cash, you have to make sure that they are there for you. So that inavailability became an issue such that it made sense to go digital. Okay. Again, if you have a bank in a village with just very few set of people, then they can only accommodate those set of people, not a lot more. Okay. So it became clear that there was a demand for that, especially when people had their phones. They're probably watching this from the phone, right? So a lot of the things that happen on the phone, it became reasonable to have a digital bank, which number one is save on the cost of real estate. So I know the irony that because banks today are buying up real estate, you know, JP Morgan just unfolded a huge building, you know, for some reason, I don't know why, and it's definitely not for the customers, I tell you. You know, the customers making, you know, benefiting from that huge building, maybe because the staff can then walk, but in truth, you don't need those huge buildings. If you have a digital bank, you want to make sure that your bank is there, your bank can enjoy your cash and spend it, and you can open up accounts if you need to. You don't really need a big bank. So that's what your bank thing feel true, right? That you have a lot of banks. Revolut just, you know, celebrated 50 million customers. There's also a new bank in the US. There's N26 as well. There's a lot of banks. There's OPay in Nigeria, across Africa. You know, again, you just put your cost of any new bank that's come out there. These new banks, again, came up just purely digital, okay? The idea is, one, they save costs, okay? And you would see if you compare them to traditional banks, and they're cheaper because you're online. You don't have to pay those huge buildings that you see. Some are silly, okay, and I advise banks a lot on this, right? Some are silly enough to actually go down the road of getting huge buildings which they shouldn't, and you can see clearly that actually impacts their customer acquisition, also impacts as well the level of quality they show to banks. I'm not going to mention any names, but we know a few that have recently created their own buildings, okay, and have a huge building, lovely buildings, but then customer service is dropped. Why? Because you just have you don't have that capability again as you would. You have to cut down the cost and then go more AI focused. You go AI focused and yeah, I'm already saying bad things. I shouldn't say that. But as it stands, neobanks just take it as they are purely digital. Okay. And the last point now becomes fintechs. Okay. Fintechs, which is what we are. So we're fintechs, and I can tell you right now we only have one thing in focus, which is payment rates. Okay. I have my mic that's like that. But your payment rate actually effectively does actually another one as well. So the payment rate just allows you to make payment. Or you can have fintech that actually then allows you on board. Okay. It's fintechs that all they do is just on board. They call it, they look at your phone, and make sure one that your likeness or your mobile is exactly the way you claim to be. You look at your passport to make sure it's clear. You also do a quick check on your background checks and money laundering rules, and then you approve immediately. Split second. That's the fintech. The fintech, basically, if you think about it, they focus on one thing and one thing only, which is one part of the bank. Okay? And they focus on that so well that they then give customers exceptional service. And if you do that, guess what? Then that also means then that you need to rely on the bank for deposits. So most fintechs, and we're the same as well, most fintechs actually rely on banking licensing, they rely on banks for deposit. You're not authorized, we're not authorized to hold customer money. Most fintechs are not. What will happen is they actually still rely on the banks, traditional banks. They're better on customers. Okay, so what will happen then? You see a traditional thing where they're coming, and in 2 seconds, someone's already on the phone to you. Which is different from the bank where you have to go in to set up an appointment, time away, take time out to make sure you're in the branch between the 94 hours or while you're supposed to be at work. So that's the difference. Look at it again, objectively, right? Again, which is better? What makes the bank a bank? I think what makes the bank a bank is one, the deposit. So they hold the deposit. That means they hold the risks behind. And I say that because there are a lot of fintechs that are coming out. So if everyone knows in the US they have what's called a bank called Yota. They claim not to be a bank, but they were a Yota bank, the other bank, as they call it in the US. And what they did was they actually are a fintech. They focus on the front end side of things and they help people, I think, just to avoid gambling. They make sure that instead of gambling, go ahead and you use your what do you call your savings as some sort of gambling effect, which I thought was a good errand as well, by the way. I'll leave that for a second. But what happened is they actually held the cash with a fintech, another fintech that specialized in front to back reconciliation. They have one fintech that focuses on customer facing front end, beauty, focus and everything. We have another fintech that does front to back reconciliation. And then we had another fintech in the background, which is basically the bank, Revolve Bank. And what they did is they had and something broke in it. So Synapse was in the middle. Found out that they were not really good at reconciliation. There were a few bankruptcies or let's call it fraudulent activities that happened back then, and such that they were not able to reconcile or actually customer deposit customers cash. Okay, so what happens there? One chain is broken. Okay, and those are still they haven't failed. So that doesn't come in, the FDIC insurance doesn't step in. However, you're down, okay, because the customer you can't have deposits, you can't have your access to deposits. People want a lot of money there, which wasn't the idea, right? And it just highlights the importance of one, having a fintech bank, and number two, the fintech then making sure So one thing is always make sure that you focus on yourself. Okay, I repeat, focus on yourself. Your bank is not there to serve you; they're there to serve investors. Okay, what I mean then is, if you have a bank that you don't trust, if you have a bank where you can't contact the customer service for some reason, maybe it's always AI. I see a lot of people do this. A lot of people complain and go, wait a minute, I'm not talking to my bank, or I'm trying to get access to my bank for 5 days, 6 days. They haven't come back to me. Leave. Okay, leave. Just next month, make sure you transfer across, because there's a lot of banks these days. There are a lot. Now open up, they'll go for your business. They need you more than you need them. So wait, on top of that, you now have neobanks. Neobanks are purely digital, which are better banks, because they're there for you. Okay, you don't intrude. As long as your deposit is insured, as long as you have a deposit that is below 250,000 K, then you're covered in euros. So wait, how about euros? 100,000. How about any other country? Deposits are generally covered. So what that means then is, certainly you don't care about, or you should care about the bank, but in truth, customer service is more important. The bank needs to be there for you. They're not there for you. Go to your feet. Leave. Go get another bank tomorrow. Again, I've always said you should have 4 banks. Four. You should have your salary bank. You should have the bank where you use for your savings, which is separate from the bank in case that goes wrong. You make sure you have that bank there in your hand. Okay. Oh, number 4 as well, you make sure you have your retirement account. That should be a separate bank. It shouldn't be the same bank. There's a lot of retirement companies out there now that focus on pensions only. You shouldn't have that with your bank. No matter how much they claim to give you in terms of sales, they're not. You would always shop better by checking out. And then lastly, there's your savings account or your spending account. I call it your pay yourself account, which is basically your tap and you go. I'm not going to say or try and sell ourselves, but I think we're the least risky of that, right? Because if you have a savings account, how often do you check your savings account? A lot of people I can tell you a lot of banks that have gone down where customers had about 20,000, sometimes 25,000 in savings, and then they have to fight to get that money back. So that's a risk. Okay. Oh wait, what's more risky than is your mortgage? Okay, if you have a mortgage with a provider, that's 250,000 minimum, sometimes up to $1 million. That's a huge risk. That's an exposure to that one bank. Okay. Same thing as well with your savings, your pension. Your pension is another big one. You rely on that. For some reason, your pension provider goes down, 401k goes down, the provider of 401k goes down just before you retire. That's a huge risk. Right? Which is different from your pay yourself account you're using every day. So our range, just basically people put money on it and then spend it before the end of the week. Okay, so the turnover rate is so high that we don't fail. That it's not possible for a spend yourself or fintech or a small bank to fail, because customers are using the money so much that the liquidity has to be there. So our customers, for our rings or our bracelets, you tap and you pay. So that means the customer tops up, $200. By the end of the week, it's gone because they use that money to pay for food, to pay for restaurants, to pay for train tickets, to pay for everywhere, right? Those that go for runs, you just pay to buy coffee or buy water. So it's a lot more fluid in terms of the usage, right? Such that the risk of failure on small fintechs like ourselves is actually lower than traditional banks where the money is there and it's parked for years and they believe they can use that money to spend or just, let's call it squander. So be careful, vote with your feet, and make sure you have multiple bank accounts so that you diversify your risk. Thank you. Thank you for joining us for this one, and I'll catch you on the next one. Bye.